Good morning, everybody. Welcome to the Flow Show. Just the four central banks we have to go over today, not three, as my guest today likes to point out. But we're down to two of them, two more to go, BOE and Banxico, and that's the reason I brought in Mr. Michael Brown today, because he likes to have a moan up at the Bank of England. So might as well give him another platform. Morning, mate.
Very good morning to you, mate. After the fun of the Fed yesterday, I absolutely brimming with excitement for the BOE in 90 minutes' time.
Contain yourself, man. Contain yourself. Right.
It's like Christmas morning this today.
Yeah, every 6 weeks is Christmas morning. Right, let's get through some of the headlines and data points first. I'll get through those pretty quickly, then we'll have a good old chat with my old mucker. China kept rates unchanged, LPR rates unchanged. Oh, where am I going? There we go, at 3.1 and 3.6% as expected, not ready to loosen the purse strings just yet. I thought we might have got something by now, but an RRR cut is still potentially on the table. We've got a bit of data out from down under. Kiwi GDP coming in okay, quarter on quarter up 0.7%, year on year, not as crap as it was expected or previously. So things ticking along over there. Australia jobs report looks a bit stinky. The employment change was down more than expected, just under 53,000, was expected to rise by just under 31,000. So a bit of a knock there. The bulk of that going in full-time jobs. The unemployment rate stayed steady though at 4.1%, which you might think is a bit of a saving grace, but that was likely because we also got a big dip in the participation rate. So people coming out the market makes it look, even though the unemployment rate stays the same, it still makes it look a weak report. Not that you'd notice that in any of the Aussie moves at the moment, which is all pretty much following what's going on in the yen. UK jobs, which is still not worth the paper they're written on. A bit of a jump in the claimant count, up 44,000. Wages still staying sticky, 5.9% ex-bonus. A small pullback in added bonuses to 5.8% as expected. 3-month employment change, though, showed a gain 144K. Unemployment rate also staying unchanged at 4.4%. No real change to the jobs market there. It's still got some weak elements to it, still got sticky inflation, but at least unemployment rate isn't rising too much. German PPI data out as well, not as hot as expected up 0.2, came in minus 0.2 year on year, missing expectations as well. Over to a couple of the central banks this morning. SNB, they cut rates 25 pips as expected to 0.25 from 0.5%. So they are basically one cut away from zero. There was no change in the statement regarding future monetary policy moves. They kept the standard line in that the SNB will continue to monitor the situation closely and adjust monetary policy if necessary to ensure that inflation remains within the range consistent with price stability over the medium term, which in essence says they are happy to keep going if they need to keep cutting. New chairman Schlegel says the risks to the outlook are predominantly to the downside. The outlook for Swiss inflation is very uncertain and the SNB sees mainly downside risks, painted a bit of a bearish picture there. Riksbank, they held rates 2.25 as expected, and they assessed that the rate will remain at this level going forward, saying that CPIF inflation has become higher than expected. Just want to bring you in for that UK data, mate.
Oh, do you have to?
Yes, because there's no point you being here otherwise.
True. Can I just apologise first? It seems that as soon as I've joined this webinar, a flock of crows has decided to start making a whole load of racket outside. I don't know whether you can hear that. Well, exactly. I'm starting to get worried now.
Portents of doom, mate. Portents of doom. Yeah, so that data still a bit of a thorn in the BOE side, particularly those wages numbers.
Yeah, massively. I mean, let's take a humongous pinch of salt first before we discuss the figures, because as you rightly said, the ONS still can't get accurate data on this. But yeah, I mean, the nub of it is that you're dealing with earnings growth that is, as near as makes no difference, 3 times above the Bank of England's 2% inflation target. Clearly, that pace of earnings growth is not compatible with a sustainable return to that inflation target over really any time frame. The only thing I would say is I'm slightly surprised that unemployment held steady at 4.4%. But then again, the risks to that number are clearly tilted to the downside. This is January data. Obviously, we're now at the back end of March, and we are a fortnight away from the national insurance changes, whereby contributions for employers in the UK, for those who aren't aware, are going to rise very, very significantly indeed. So I think it's sort of steady as she goes in terms of the jobs market from the data this morning, but clearly the risks are significant, and those risks pretty much all tilt to the downside, be it in terms of layoffs or in terms of hiring plans, which have basically just ground to a halt.
Yeah, looks like a case of the worst is yet to come. And you're talking
Sadly
like a
so.
true central banker with those risks to the downside lines, mate.
Well, the number of central bankers I've listened to over the last 12 hours, mate, I wouldn't be surprised if I've become one, to be honest.
Another thing that was out, Rachel Reeves seems to be dialing back a bit. Apparently now, according to reports, she won't be making any tax changes next week in her budget statement, her spring statement. Those were potentially being threatened alongside these cuts to the welfare bill, sort of a double whammy for people. We talked about this on the trade off this week. It seemed I was expecting maybe some storms next week over all this. We still will get the market reaction to it all, obviously, but she seems to be trying to take a bit of heat out of this.
Yeah, she does. Although it is a bit of a double-edged sword, because the reporting went on that while she might not make any tax changes now, she's just going to delay them until the budget in the autumn. So, kind of giving with one hand and taking with the other. In many ways, while I'm kind of pleased because it's better for our back pockets, to put it bluntly, I do think it's a bit of a dangerous game, because if you're trying to convince or reconvince markets of your fiscal credibility solely by delivering spending cuts, which, let's be honest, without wanting to get political, when as a Labour government ever successfully delivered significant spending cuts, I think the market's probably going to take quite a dim view of that, if that is all we're going to get. Because I think one of the reports I saw said that would add about 5 billion quid to the fiscal headroom. Well, we're 9 billion in the hole, so where's the other half of it going to come from? Is the
Another
ultimate
black
question.
hole.
Yeah, well, another one. Yeah, it keeps getting bigger by the day.
Exactly. Yeah, I mean this thing next week, it's going to be a credibility thing for her. I think, amongst other things, that might even be the bigger thing out the whole thing, is that it's going to be another credibility issue for her, because she's not done very well in terms of how she's spun things out thus far. And I still think that we may get some waves for the pound if the market takes a dim view. And again, it won't be per se the exact policies; it will be the market's view of how those policies are going to affect the economy, whether what she wants to do is achievable or whether it's going to just crimp growth even more. And that's going to be the reaction we need to look for next week.
Yeah, and just lastly on that, the one thing that I would look for in terms of, I know we'll get into markets in a second, but in terms of market reaction to the spring statement, the really important thing to watch is, does the relationship between gilts and the pound break down? And what I mean by that is, do we see a situation where gilt yields go on an absolute tear and sterling falls through the floor? Because if you see those two things happening, that's a kind of classic red flag that the market has basically lost confidence in the fiscal stewardship of the economy.
Yeah, very much so, mate. And that's what we'll be looking at next week. And I'm going to get you on and Ryan Mark II on as well, I think, next week. And we'll have a little chat, maybe do that before the old spring thing. Anyway, moving on, ECB was real Roy still claiming that inflation will be at their 2% target in the coming year. I really can't wait for this bloke to be wrong, but that's another conversation. Says we cannot have a new policy of spending whatever it takes regarding defence spending. Lagarde was popping up in Parliament, some hearing, whatever. She says that ECB analysis suggests that a US tariff of 25% on imports from Europe would lower euro area growth by about 0.3% in the first year. So they're starting to put some numbers to the potential tariffs to come. US MBA mortgages yesterday, just something to keep an eye on because it's been on a pretty strong run. That did give a little back. Applications down 6.2%. No real massive change in any of the underlying components there, though the rate did tick up by 5 pips to 6.72%. We've been on a good run through the whole of March, beginning in February really, and we've seen that slightly in some of the harder housing data, starts and permits as one example this week. So this is another reason why I keep an eye on this one. It's just a bit of a small weather vane. Right, over to Mr. Powell and his purple tie. Kept rates unchanged.
Yeah, you've got this weird obsession with his tie, haven't you?
Yeah, well, usually I've got nothing else to talk about than what central bankers are wearing. Especially with Lagarde and some of the monstrosities she pops up with, like that orange jacket the other day. But, I'd like to see something different. I think I've seen him wear a silver tie once. So I don't know. You know me, I like to make a joke of these things, but anyway. The dots squeezed as expected. So some of the more extremist views, shall we say, just edging their dots up and down the respective ways. We're still pricing 2 cuts, or they're still expecting 2 cuts this year and next year. The only thing I did pick out was the 2027. Now roughly looking at 1 cut versus 2 cuts. Is that obviously a reflection of the prior cut that we had before they went on pause, mate?
Well, very good question. I mean, I think the key thing with the dots is that the median did not change. And it's actually the first time since December of 2020 that the median was unchanged throughout the whole forecast horizon, which I thought was interesting given the uncertainty that we've got going on the economic outlook. I mean, as you said, the dispersion has shifted. The doves have effectively become more hawkish, as you would expect. But to be completely honest with you, I don't think we should be placing any weight on the dot plot whatsoever. I mean, we're effectively, what we're doing with the dots is asking 19 economists to mark down where they think rates are going to be over the next 3 years based on an economic outlook that is probably the most uncertain it's been in at least half a decade. So I'm not entirely sure. And I think it was very telling that Chair Powell himself, actually, before he even handed it over to the Q&A, said in his statement, the dots are not a commitment, and really trying to distance himself from those projections. So, clearly the Fed are just trying to give themselves as much flexibility and optionality in terms of the policy outlook as they can. And not really a lot else they can do at the moment, I don't think.
No, exactly that. In their other forecast, they cut growth, raised inflation, and left unemployment largely unchanged. That was pretty much as expected. A couple of pips moving around in that lot. What they did do, which sort of came as maybe a bit of a half surprise, because we were perhaps expecting a nod to it, but we got it in full scale. Anyway, they said that they are going to be slowing QT. They're going to be slowing from 25 billion down to 5 billion starting in April. So that's their, as we've been saying, easing without actually easing type of move. That gives a little bit of looseness to financial conditions. It was expected, as we said, but whether it came this meeting or the future meetings, we now know it's coming from April. They also, well, here we go again with the we make changes to statements, but they don't mean anything.
Yeah.
They removed the line on risks to achieving employment and inflation goals are roughly in balance, and replaced it with uncertainty around the economic outlook has increased, which Powell went on to say wasn't anything that we should worry about. It's just another language technical change, or whatever you want to bloody call it. But to be fair, as you just mentioned, mate, he's absolutely right. The same as every central bank, they don't know what's coming from this tariff crap, and it's hard to put numbers on it or decide what they want to do.
Yeah, absolutely. And do you know what? In many ways, and I was talking about this with the other Ryan a little bit earlier on this morning. In many ways, I find it quite refreshing and reassuring that Powell has effectively stood up and gone, look, this is our best guess of what's going to happen. We think the economy is in a good place. Inflation is probably going to be a bit higher, growth a bit lower as a result of these tariffs, but he didn't. They were ultimately quite open and honest in saying, we don't really know what's going on, and we don't have a lot of conviction behind what we think is going on. And in many ways, I would prefer that as opposed to, someone standing up and trying to fob us off that they know everything and this is the preset and defined path for interest rates. Because in this sort of an environment, you just cannot do that. So yeah, in many ways, I think the Fed, certainly last night, and actually for the next probably 6 weeks or so until the next meeting, I would imagine they're going to try and stay on the sidelines and make as little news as they possibly can, and just digest everything that's going on.
Yep, no, absolutely, mate. I can agree with that. This is probably one of the only times that you can actually have some sympathy for these central banks, that they're in got as much idea as what's going to happen as we do, and they're just in wait and see mode at the behest of the orange man. Anyway, Powell went on to say the US economy is strong, labour market conditions remain solid, and inflation remains somewhat elevated. He said that this was a technical decision to slow the pace of the balance sheet decline, i.e. QT, and slowing that.
He said that was interesting.
Yeah.
For two reasons. Sorry to shamelessly interrupt you there. The first is because the Fed are now framing balance sheet runoff as technical, but increasing the size of the balance sheet is apparently stimulus when they do QE, which is a little bit of a difficult sort of circle to square. The other thing that I do think is interesting is that rather than ending QT entirely, they've put a cap of $5 billion per month, which is so meager in the size of their balance sheet that it may as well have just ended entirely. But I think that's a signal they were trying to send, because if they were to end QT entirely, then they become a net buyer of treasuries again. And I think the Fed are probably trying to avoid that for as long as they possibly can, just so that their message doesn't get, a little bit mixed up on that front.
Yeah, sort of puts their monthly trading at break even or flat, if you like.
Yeah, exactly that.
Yeah, no, I agree with that, mate. He went on to say surveys show heightened uncertainty, but it remains to be seen how it will affect the outlook. Then he's dropped the bomb again on PCE data, saying that prices likely rose 2.5% in December. Core PCE prices probably rose 2.8%. Says inflation expectations have recently moved up with tariffs as a driving factor. But says longer term inflation expectations are consistent with the 2% goal. So he's not that worried about these short term inflation expectations going up. Then he mentioned our old mate, the University of Michigan sentiment survey, saying that inflation expectations in that were an outlier. But then he did remark that sentiment has fallen off, but the economy seems to be healthy. There's no need to be in that hurry. We're well positioned to wait for better clarity. And transitory is back, mate. I know you jumped on that last night as well. We got asked a question about the tariff impact in inflation and whatnot, and he said it's unlikely to be a lasting thing. It's going to be transitory. We're playing that game again.
Yeah, well, let's. I mean, I actually went back this morning. It's the first time he's used the word transitory at a Fed press conference since 2021. And all I can say is let's hope that it ends a lot better this time than it did last time. You would like to think and hope and pray that policymakers have learned their lesson in the intervening period. But yeah, I thought it was. I was literally about 30 seconds before he did utter that line. I think I tweeted something along the lines of he's desperate not to use that T word. And then he did, which very much surprised me, because they're very deliberate in the language that they use. And I thought they'd try their best to avoid even going near that path, but apparently not. So we'll see how that one ages.
Yeah, and well, I hope they do make the same mistake again, because when they were talking about transitory last time, I was buying dollar yen down in the low 100s, and I was very happy with that trade. So yeah, I'm all for them fucking that up again, as far as trading goes. Anyway, other traders in futures traders particularly see now a 62% chance of the Fed starting their cuts in June versus 57% before the decision. I did have a look, but I've forgotten now. How have you looked at the shift in the calendar between the months, whether we're pricing, obviously we're pricing June at 62, but how the other months are faring, September and the others? Any shift there, mate?
I'm literally looking at it right now, and actually, we've seen even more of a dovish shift this morning, which is, to be completely honest with you, solely by virtue of the lurch lower that we've had in risk assets recently. But yeah, right now we've got about 85% chance of a cut in June, and by year end we've got 67 basis points in the curve. So effectively, a 2 in 3 chance that they deliver 3 cuts by, excuse me, by the end of the year.
Yeah, thank you, mate. Good update. Trump obviously had his say after that, and he said the Fed would be much better off cutting rates while the tariff stuff's going to ease into the economy. He always wants rates down. That was funny last night. One of the reporters questioned him about these other federal workers. Oh, I can't remember what they were, head of something like that.
FTC commissioners or
Yeah,
whatever they
them
were.
lot
Yeah,
getting sacked, and he asked whether that would mean that Powell's going to get sacked again, which he didn't take kindly to. Basically, in polite terms, told him to fuck off.
yeah.
But that made me chuckle yesterday. Nvidia, they're trying to get on Trump's good sides. They're apparently going to spend hundreds of billions on US chip making over the next 4 years, and if Trump's out the door in 4 years' time, then they'll probably take their money back out again. But anyway, next 4 years, you can expect lots of chips to be made over in the US. Now back on to Ukraine stuff. We still had the to and fro. Zelensky had his meeting with Trump yesterday after the Russia phone call. Hopes peace can be made. Russia's up to no good. Blah, 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 blah. I still don't know whether we got an energy ceasefire or not. US Special Envoy Witkoff has said a full-on ceasefire in Ukraine is more complicated. His understanding, and this is as of yesterday, that energy assets are off limits as of today. Thinks we can get to a full-on ceasefire in a couple of weeks. So still some time to go. There are meetings this weekend, and I think into the early part of next week over in Saudi Arabia between Russia, US, and whoever else. So that might...
I wouldn't hold your breath on that one.
No, but still maybe present some weekend headline risk depending on what comes from that. You never know. So
indeed,
I think we might again see a bit of risk reduction going into the weekend, like we did last week. So something to keep an eye on for tomorrow, at least. Right, you got anything else you want to bring us? Because I'm done with the headlines, mate.
Well, we need to address the elephant in the room of the old lady of Threadneedle Street at some point, don't we?
Yeah. Well, let's go right to it then. Okay, I'm going to go and make a coffee while you.
Oh.
But so here's the numbers. As always, the important stuff: rates unchanged. That I think is pretty much done and dusted. Again, as we spoke about on the trade-off, this vote thing could be all over the place. There's so much uncertainty in this, particularly what Mann did last time, Green did. We got Taylor coming in as well. So I've got no expectation for this. It could be 7-2, 8-1, 5-4, 6-3. I don't know. What are you going with?
Well, I was going to say the other complicating factor with that vote split is, are they dissent? So rates are going to remain unchanged. Let's just take that as read. The other thing with the vote split is, are they all going to dissent in favor of a 25 basis point cut, or does anyone fancy a 50? Because obviously last time out we had both Dingra and Mann who voted for a 50 basis point cut when bank rate was actually reduced by 25 basis points. So yeah, I mean, like you, I've got absolutely no idea where it may end up. up, nor is the sell side, for what it's worth. I've got a whole host of forecasts in front of me here, and they range from the vote split being 8-1, with that one dissent being for 25 basis points, all the way through to a split of 5-3-1, with 3 dissents for 25 and 1 dissent for 50. So basically, no one's got a clue where that vote split will end up. But I think, to cut through some of the noise, what I would pay attention to is who is dissenting, because it's likely to be, as you said, a combination of Swati Dhingra, Catherine Mann, and or Alan Taylor. Now, the important thing with that is that none of them are what you would call internal members of the BOE. It's not the governor, it's not his 3 deputies, and it's not the chief economist. And you do tend to see the external members being slightly more wild, shall we say, in their policy decisions. And I think unless we get an internal member vote for a dissent in favour of a cut, then, to be honest, I wouldn't be overly worried about whether it's 1, 2 or 3 dissenting for that sort of a move.
Yeah, exactly. I think the market will still move depending on how many are voting for cuts, whatever, whether it's a 25 or 50. So just to take this one at face value, market roughly looking at 7-2. So if it's anything more than that to the cut side, that potentially means that a cut is coming closer. That's probably going to drive the pound more so than the rest of it. There's no press conference for this one. It's just meeting, decision, minutes, statement released, on you go. Bailey popping up on, I don't know, Humber side post at 5 o'clock in the afternoon type thing. So yeah, I don't know. I'm a bit short the pound against the euro at the moment. Long euro sterling. That's more of a trade to run into next week. But I may sell a little bit of a rally if there's one in cable up to 130 again, if we get something that puts it at odds with what's going on in the other pairs. But yeah, or else I might sit on my hands.
Yeah, to be honest, I think it's going to be very, very choppy, but I think the March meeting here is just going to be a placeholder more than anything. Yeah, I don't think the BOE are famous last words. I don't think they're going to surprise us too much. But also, I think that they, like everyone else, are just dealing with so much uncertainty. And of course, they've also got the spring statement next week and the NI hike to grapple with. That, yeah, they've just got no incentive to be rushing into anything right now.
No, but then just to throw a stick in the mud, could they go a little 25, take a line out of what the Bank of Canada did and said, we continue to cut rates because we want to try and front run any trade problems, tariff problems. Not that we're going to get affected as much as everyone else, but could they sneak a little softener in?
I would say the chances of that are very, very slim indeed. The big difference between the two being that when the Bank of Canada made their March policy decision, inflation was at 1.9%. The BOE are making their March policy decision with inflation at 3%. So I think it's a very, very different kettle of fish that Andrew Bailey is dealing with, and probably eating as well.
Yeah, I think it's a low risk thing anyway. I've maybe put a 5% chance on that they do it. But this is the Bank of England, and that 5% is enough anyway. Right, so that's the Bank of England going. We have got a bit more data out today from the US, jobless claims. We'll wait to see if that one ever pulls a wobbly one. Otherwise, it's ticking along as it has been. We get Philly Fed manufacturing, follow up after the earlier Empire State manufacturing. And then it's pretty quiet going into this today. Bit of housing data later on. Right, let's have a look at what's going on. You've got a bit of moves in the yen this morning, which is a bit strange because it's been a Japanese holiday today. But yen seems to be doing a lot of the driving. If you go around a lot of your yen pairs, you see the same old picture at the moment. And as I said, that's pulling a lot of the majors down. What are you making of the euro at the moment, mate? I've been saying that we've been struggling to make a top where this zone is just, this is a big old zone. This goes back decades. And we're turning around it again. Do you see any reason why the euro tumbles all the way back down, or any reason why it continues going up?
Well, this is the interesting point. I mean, I think, you say that we were struggling to form a top. I think this 109.5 region probably is, for the time being, going to be very, very stiff resistance. I guess it's a case of, the euro's priced in a lot of good news at this moment in time. And certainly all of the.
Hold on. Where's the good news?
Well, I think the good news is the fact that they're finally getting their act together on the fiscal front, and the market is suddenly becoming increasingly attractive, certainly relative to peers. If you look at the United States, and if you don't want to be exposed to uncertainty on the trade and tariff front, you're not going to be wanting to hold the dollar. So you've got that mechanical impact as well. I think we do need a catalyst now, though. This is the problem, and we've just ended up in this kind of sideways drift over the last kind of week or so. I guess the big one that would force the common currency to the upside would be if we were to get some kind of concrete progress towards a ceasefire or a truce in Ukraine. That would take out a chunk of geopolitical risk. You probably trade 110 on the back of that. Whether that comes is obviously an open question, but I think, personally, I would be more favoring euro upside here than downside, which does make me, feel a little bit peculiar, but yeah, that's how I still see it at the moment. I fundamentally dislike the dollar right now, and lessen until the Oval Office substantially change the way that they're operating and begin to do things with a bit more coherence.
Yeah. So what did you make of that when we got that announcement finally in German Parliament that they passed all their debt brake reform and everything, and we saw pretty much nothing in the euro. It ended up going down.
I think that just felt like a classic buy the rumor, sell the fact kind of reaction to that. I think really, not just in the euro, but I think the DAX ended the day in the red. You also had Bunds, which actually rallied despite Germany signing off on 500 billion of extra spending. So yeah, I wouldn't be overly concerned about that, but I guess it does just feed back to that point about that narrative's run its course now. That's what's taken us from, my eyes are terrible, but 104-ish, I think it is on the lows there at the start of the month, to 109, which is a huge move in a very, very short space of time. It's natural to have a pause for breath after that. Now it's a question of the market going, okay, great, but what's coming next?
Yeah, absolutely. I think that's been my view actually for pretty much since we started all this sideways action. It's going to need something more, and if it doesn't get it, that's when you've got to be worried about being long and seeing perhaps a further push down under some of these support levels. We've just had a bounce off this 30 level, so this is holding up. Now we might have to see whether we get a move back to 70s and whether that starts to resist, and then we might be needing to find direction again by what happens if it moves out of either side. But as I've been saying, this zone, when we're in it, it makes decisions, and while you're staying on top of it, then you've got a chance of going higher. If you're staying below it, the opposite happens. One day we will move away from it, and then you'll have to note this one in the history books if we ever come back to it. Quick look at cable. I will look at Aussie dollar Mike, no problem. As I said, a lot of these, it's not really a dollar move we're seeing here. It's very much, as I say, a bit of a yen driver. You got any ideas why the yen's got its thing on this morning, mate?
Profit taking, end of year flows, more sellers than buyers. Take your pick, I guess.
You'd make a good economist, mate. You'd make a good economist.
In case people hadn't realised, I'm not being entirely serious. No is the answer. I don't particularly know what's caused that. But as you say, it was a public holiday in Japan overnight. So I don't know whether, thinner liquidity, lighter volumes, whether that might have contributed to a bit of the funkiness that we've seen there.
Yeah, exactly. I think yields as well. We've seen a bit of softness in US yields as we did yesterday over the Fed. I'll look at those in a moment. Cable, otherwise, we've had a little pokey under this 129.5, a bit of an on-off level. We're back above, so that looks like to be the line you want to keep an eye on at the moment, at least for today. Below there, got a bit of stuff going on. 129.20 is down into the figure. As always with cable, it likes to trade around the double O's and 50s So just keep an eye on those levels. But again, this might turn into a bit of a failure up at 130s. It might lead to something more, particularly going into next week. Right, Aussie dollar for you, Mike. Again, zones in play. Failure to get through.
Sorry. You mean
sorry.
Mike in our chat there? I thought
No,
you meant
Mike in
Mike
our
as
chat.
in me.
Yeah,
I was
well,
thinking, I haven't asked for that.
Well, if you've got a view on the Aussie dollar, then please share it. But I was just highlighting to Mike in our chat there. This failure at 64 has proved to be costly. We're down in this zone. If we're getting under here, then it's going to put this whole phase and bounce from the 62 area into question. I don't have a fib on it because it's a bit too short term for me. But this is the area. If we hold anywhere top, bottom, then there's every chance of maybe pushing back up towards the highs. If we get a quick return up here, though, next couple of sessions, next day, that would potentially mean we're going to have a proper attack on this 64 area. Aussie Kiwi, that stopped falling down. I'm not sure. I've been getting some funky pricing on this recently, so I'll have to have a look whether we got down to those lows. But potentially we got down towards the low 109s, but had a bounce. Kiwi's going a bit faster on the downside this morning than the Aussie, hence why this is ticking up a bit. So I'll need to keep an eye on that.
They are sorry, mate, but they are legit quotes, at least according to the Bloomy feed, anyway.
Yeah, cool. Thank you very much for that confirmation. I was looking for a move sub there, but it hasn't held it anyway. So we'll see whether this bounce continues. We've got a bit of traffic, just form a resistance point on the breakdown around this 60s area. So I'll watch that, and then obviously 109.80, and then up into the 110 from here. What are your thoughts on Euro Sterling, mate? I'm a bit long this. I might add a bit more if we get a dip on the Bank of England. I'm not feeling too confident about the quid going into next week.
No, nor am I. I think next week could be very dicey indeed for the pound. And actually, I say that not only because we've got the spring statement, of course, but also, and I only realised this courtesy of Helen Thomas at Blonde Money, so thank you to her for that. But the spring statement has been scheduled on the same day as the latest inflation figures, which will come out at 7 o'clock next Wednesday morning. And it's also sandwiched in between gilt auctions on both Tuesday and Thursday. So, and then of course, you've got retail sales on Friday as well, and flash PMIs in the mix, none of which are likely to paint a particularly brilliant picture of the UK economy. I think I'd be in the same boat as you on this one, mate. I think next week we're certainly going to be a busy week for UK traders, and I think it could be a bit of a rocky week for pound, if I can get there in the end.
Yeah, exactly. Oh, that's going to keep us busy doing our notes for next week's trade-off show anyway.
It is indeed, mate.
I'll leave that one with you, mate. You can take that one. So
thanks.
if I see a dip on this on the BOE, I might just pick up wherever it goes. But down to 70s, maybe down to this sort of 30s, 40s area, I'll add a bit to the position. I'm not going overboard trade size. But I'll keep an eye on that one as well. Right, gold to edge. Of course, I'm going to look at gold. Always going to look at gold.
Is it shining still?
Yeah. Let's go into a bit of short term. So we had this stuff last night with the Fed, new highs. I've been saying we're not ready to make highs yet and rely on them. We might have something developing though, because we got down through this minor area, 38s. And look where we've bounced, coming into that 20 area. So this is now confirming a bit more as a support level to watch. So take your cues from this. If we're bouncing off of here, it keeps just even this phase going, and we may go into new highs. What you want to see, though, if you're looking to pick those tops, is a run up to maybe 30, 50, maybe just around those highs. And if we fail to break those highs, even by a buck or two, that would then set up the potential for a more solid top. But even so, it still might just be short term like we've had here. So you want something a bit more than just a couple of days or a couple of hours. You want, as I've been pointing out before, this type of move. Okay. where you start to get some decent tops forming over a longer period of time than what we've seen thus far. So mark your tops there for now. You want another confirmation of that, and then you want it coming back below this support and this support. Because if we don't, then it keeps the upside momentum going, and on we go. But for now, technically, it's, if you're looking at the levels, it's doing the right things. If you want to try this one up at 20s, 25, you know, you don't have to be wrong $50 to know that the trade is going offside, and then you can look at the other ones. Mike in our chat is saying, do we have any insights about end of quarter flows? Not this early, mate. We'll get those probably from next week.
That was actually me just messing around, by the way, when I said that about the yen. As you say, it is a little bit too early to be getting that at the moment, isn't it?
Yeah, it's we would have had a Kotobi fix today because
they're all on the beach.
20th, but obviously with them being shut, I don't know if that's going to get punted. But the 25th will be a Kotobi day, so you might expect to see some flows coming in on that if you're up for the Japanese fix, which is 5 to 1, I think, 10 to 1, 5 to 1 our time in the morning. So keep an eye on that. Yeah, this is going to be a potentially big end of month, end of quarter for the yen. And yeah, it could be that some of these yen moves that we're seeing today, again, I'll point at euro yen, might just be some flows, just some repat flows picking up, getting ready for the year end, bringing money back into Japan. So it's possible. I'm not going to rule it out, particularly while the markets are shut over there. But there's other Japanese firms in other countries who have got to send money back to Japan. So it doesn't mean they stop just because of a holiday. No, I don't know if it's front running, because how do you know what to front run, Mike? You know, how do you know what firms are going to bring what money back and when? You can't really front run that. It's more likely that these are actual flows rather than people front running it, because it's a wild card. Who knows where the flows are going to come from? They're going to come from Europe. They're going to come from Australia. They're going to come from the US. I wouldn't say these are front running. More people just potentially doing those actual flows, which we know these days, it doesn't all happen last minute. It happens over periods of time at these end of quarter, end of month moments. But if you want to know, keep an eye on the clock. If you see a move happening 5 minutes, 10 minutes leading up to an hour, then you know that it's potentially flows, because we get these hourly fixes these days. People do all this business in advance, not all 4 o'clock London time like in the old days. So keep an eye on the clock if you want to try and decipher what's going on with that.
Yeah, just on that, I was going to say, like, I think any edge that used to be around, fixing flows is probably gone at this moment in time, because as you say, Ryan, they are so spread out now, not only across the day, but also, across a couple of weeks. No one's waiting until the T+2 value date to rebalance their books anymore. And also so many market participants are trying to front run what they think the flows are likely to be, that it just ends up eroding any advantage that may have produced. So yeah, I'm not, it can explain some of the slightly odd price action that we see as we draw towards things like month and particularly quarter end. But as something as a potential trade, I'm not convinced that the risk reward is huge these days, to be honest.
Yeah, absolutely. And we spoke about it plenty of times before. There's so many plates spinning at the moment that's giving input into markets. Even a year ago, 2 years ago, you could look at a move and you could find a reason for it. Now it could be 4 or 5 different reasons. It could be risk. It could be yields moving. Look what happened in the 2 years, and they're still going. 2-year US yields. We know dollar yen. We know yen follows what's happening in yields. And look, that's a big old move that we've seen since the Fed. Again, that's another input into yen pairs. And what's going on. So there's always multiple reasons right now, which it makes it tough. I can't say with any certainty that a particular move is down to a particular event. It's just, you just can't do that with everything going on. But here we are, US 10s, big old level in terms of yields, down at 420. So that needs watching, because again, I mean, this is a bit of a strange move, mate, because the Fed weren't dovish, you know. Okay, they weren't hawkish, but it's like, we're not moving still. We're staying where we are for the foreseeable future. Why have we got this big sell-off or big bidding bonds at the moment, particularly US?
Yeah, I mean, I think it's twofold. I think it's firstly, and certainly the initial move that we saw over the FOMC last night, or yesterday afternoon, if you're in the States, good morning to you. That would have come primarily on the back of, I think, participants who might have been a little bit wrong-footed and were effectively positioned for the Fed to more overtly acknowledge upside inflation risk and potentially move the dots and the rate profile a little bit more hawkish as a result of that. And clearly that didn't happen. So you've just got people unwinding all of those hedges that they might have placed. I think then the move that we, and that momentum has obviously continued since the start of the European session. I think that's a combination of a little bit of haven demand coming in, because obviously we are seeing equities trade softer across the board, and the dollar is a little bit firmer. But also, I think that is where you might potentially be starting to see the impact of that QT decision sort of being fully felt, because you now have a much more supportive Fed, particularly when it comes to the longer end of the Treasury curve. You think about the pace of balance sheet runoff; it's now at 20% of what it was. That's naturally going to provide a little bit of a fillip to the long end. But fundamentally, yes, 4.2% is a big level in the 10-year. 4% is a big level in the 2-year, which we're below this morning. But realistically, we're back to where we were, about this time last week. So I think, again, it's interesting moves, but we only get excited when those levels start to break down, I think.
Yeah, and just going back quickly to the yen and another driver, you can see it here. We've got US yields coming down. We've got Japanese yields still looking buoyant. Obviously, they are closed today, but you can see from yesterday that they were still up. And this is another factor. We've come over 2 central bank meetings, Bank of Japan and the Fed. The Fed are on hold, and the Bank of Japan might have edged closer to hiking rates. So you've got some divergence trade there as well to put into the mix. So lots of ingredients in this cake. And I don't know if I want to eat it when it's ready. Right, let's call that a day for today. Thank you very much, mate, for coming on the show.
My pleasure, mate.
Obviously, we've got our trade-off next week, so folks, keep an eye out for that. And as I said, I'll get you and Mr. Paisley from Peak Suite on tomorrow. Maybe get you on the morning of that. When is that spring statement? It'll be in the afternoon, won't it?
It is 12:30 next Wednesday.
12:30, yeah. So maybe I'll get you on the show for pencil it in for Thursday, and we can have a good old rant about all that crap going on. So thank you very much. Thanks for coming and following us here at the Flow Show, folks. Have a great day. Thank you again, Michael. And we'll see you again soon.
See you guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.